Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good day. Ira Epstein of Linn Associates with your financial market video, and this is for Tuesday, the 27th of March, 2018. We're just after 4:35 p.m., just coming into that zone now, Central Daylight Time. All right, remember what we try to do in these videos. You know, too often I'm so used to so many of you here. The first thing, I want you to bring your friends to it. Second, I try to go over a set of popular indicators. I get people that want me to always do Fibonacci. Okay. I get people that always want me to do moving averages, swing lines. You get a little bit of everything. In this video, I'm not going to be able to make everybody happy. What I try to do is what I think are the major indicators. Now, today you're going to see some of the 200-day moving average of closes in stock indices because so many are looking at that. And that was where the last break low occurred in some of them, and the markets held and came back. Okay, we'll see what goes on from there. Today you also saw what we call the Tuesday reversal. So you had a big up day on Monday after a big sell-off on Friday, went up 700 points. I was on yesterday on Fox, and they were talking, oh, this market, it's seen its lows. I'm not convinced of that at all. That doesn't mean I'm right. It's just I'm not convinced. I'm watching the best parts of certain sectors, the FANG stocks, all giving it up now. And yes, Facebook has had significant damage done to it. It's more than just a little bit of damage. Will the regulators come in? Maybe. We'll see how that all works. But once you bring them in, business models change a bit, different things go on. The bigger picture is the market, to me, still looks as though at the end of January, the market's made a near-term top, and I think that the markets are going through a phase right now where is there a trade war? Isn't there a trade war? Are interest rates going to go up and shut off the markets, or is the Fed paying attention to what's going on? Maybe they'll pull back a little. We're going to get a lot of new financial data at the beginning of April, and we'll see. Right now, here's what you know. You got volatility galore. That is not what you had in 2017, and for the moment, I don't see anything to stop that. When we take a look at the weekly S&P 500 chart of closes, if you go back into 2017, this is it right here. Got it? From there to here. You didn't get under the 18-week moving average of closes. You did it right at the beginning of this year. You got off of it and you're back under it. You have to go way back to find that into 2016. So that vertical move that we saw all year long was due at some point to pull back because, in part, you still have earnings that are people think they're going to go on forever. I hope you're all right. I don't know. But I know when you get to earnings ratios of 18.5, 20, it starts getting a little bit rich, especially when interest rates are going up and you've got something to compete with the market. That is important. So right now we're in what we call a down thrust. We'll see where that goes. But on the chart, you can see that you're still up for the week, 18 points. It's because you were down so much the week before. When we come to just a daily bar chart, you can see the wild swings this market is getting. You had a prolonged break. You had a rally that peaked out today. You had a big rally yesterday. If we look at the amount of the rally, 61 points. Today you gave back 2/3 of that, down 43, but you're still not at Friday's lows. You could go there. Wouldn't surprise, I think, a lot of people. When the market, and you look at the swing line study, and this is this chart with the swing line study on it. That's all that it is. And it shows that you've got lower highs, lower lows. That's bearish. Where's the rally carrying to? Well, this is where we should get to the moving averages. The first resistance is the 100-day moving average at 26.95. The second is 27.17, the 18-day average. I mentioned that one of the things we don't want to see is the short term get under the longer term yesterday. I still feel that way. Now let's go to the 200-day moving average, because you're going to hear about it on television over the next 1 or 2 days, especially if we're down tomorrow. The last time this market broke, right back here on Friday, you kissed the 200-day moving average, you rallied back smartly, now you're breaking, and it's likely to give it another kiss. Doesn't have to, but it's likely. And then the question is, does it run out of selling pressure? Does it start another leg at that point? If it starts another leg and stays under it, you'll hear traders starting to talk about that. You'll hear them talk about, uh-oh, is the market going back into the zone in February of those lows? I would not be surprised. When we go to the S&P and look at Bollinger Bands, you fell back in and stayed right above it on the close. You're not in violation of staying out of that algorithm. You can run that algorithm's down leg right here. See that black line? And just stay within it, and you are oversold. So, a couple of things. Do you get end of the quarter window dressing in these markets? Do we get people that just want to go away now for Easter and come back and they'll address the markets on Monday? Remember, Thursday's the last full day of trading. There is no trading on Thursday night. So tomorrow and Thursday are important in the market. The markets will reopen on Sunday. They are closed on Thursday night and not open on Friday because that's Good Friday. Then we take a look at the NASDAQ. Coming down to the lower Bollinger Band, hasn't violated anything. The Dow, down to the lower Bollinger Band, hasn't violated anything. So I go to the Russell, and in the Russell, down to the lower Bollinger Band, and this is the 200-day average that we haven't gotten back to since that February break, where this was the market that didn't hit it. Okay, I can live with that. If the market breaks through here, hitting it, I don't think it's going to surprise anybody, and I don't think they'll get that worried about the market. In the VIX, I'm going to stick with what I've been telling you. This whole area of when you went sideways in 2017, that now the top of that is probably acting as the support level for the market, as the market is taking the sideways action and finding out what's the new trading top in the volatility. I think that the trading bottom's probably close to this, the 13.15 to 14 level. Is the top of it closer into the low 20s? That's what the market's trying to search for. And that means volatility, unlike when we were back here at 9 and 10, has gone up about 40%. That's quite a bit, maybe 50%. So you're starting to get these volatile days where you're getting these broad ranges, 1% moves or more, and you did not, and you were not used to that in 2017. Then the market's surprising traders because here we are offering, what, $100 billion this week in notes and bonds, and the market's absorbing it and moving to the upside. We're also taking the spread between the 2-year and the 10-year and sort of bringing them back in the line. Okay, I think the 2-year's like 2.28 if I'm right, and the 10-year's around 2.8, 2.78. The 3% level has been hard to breach. We had one run at it, didn't go very far, and now you're back into an area of resistance. Remember, the higher the futures go, the lower the real yield goes. They're an inverse market. This market's overbought. Each time you've gotten up here in the past, you've pulled back a bit. I would not be surprised for that. Is the trend up? Yes. Is the market overbought? Yes, and it's at a resistance level. In the 10-year note, it's the same thing. Are you going to be able to break out of this back to the upside? If you do, that's going to take the actual yield that's around 2.78, as I said, and drop it even further. I don't know if the market's really going to be able to do that and hold on to it. You've got higher lows, higher highs. Again, you're the first time outside of that Bollinger Band. You can stay out a couple of days here, especially if you get a stock market break. Will it go very far? That becomes the big question. Overbought condition in an uptrend. Dollar index bounced away from that lower Bollinger Band, had an outside day up. I'm looking to see if we get the resistance come in at 89.38. Now, the problem is for sellers, you're in an oversold market. If you think people don't look at overbought and oversold, fine. I think they do. And I think that what you've got here is a pattern of a higher high and a lower low. And we've had this on market. It makes it difficult for traders. Now, in the euro, you got up yesterday to your objective of the upper Bollinger Band. You can see we got to 125.40. The Bollinger Band was 125.34. You exceeded it today and then slipped back. No surprise again. Why should you be surprised? The market's in a sideways band deciding, deciding, is this going to act as a base and lift the market? Is this a top where the market's going to drop? You have to make your decision from there. I can tell you that the marketplace is no longer in overbought territory. It's dropped back a little bit here, and that's not bad action. I would expect to see buyers step up to the plate here in the 124.35 level. In the British pound, as I said, you were running into a lot of resistance in an overbought condition. You've kept that overbought condition because the two numbers that make up the slow stochastic, it's a momentum indicator. There's MACD, relative strength, there's many of them out there. And if you believe, as I do, that momentum often leads price, well, then you start looking at these indicators. Remember, the word is often. It's not always. I don't know anything in the markets that it's always. But as I look at this, both numbers are over 80. Let me take you here. On Monday, they were both over 80, but not on Friday. So this is exactly the spot where the market is vulnerable, because more times than not, in fact, quite a bit more, the markets on that third day, the red line turns back under the 80 level, which is accompanied often by weakness in the market. In the Japanese yen, you did not today get the safe haven buying. So even though we broke in stocks very hard, the buyers didn't show up. The market fell to what I've been telling my traders. If you get my research, I've been talking that I thought the market could have support on a pullback against the 18-day average of closes. My problem on this chart as a chartist is this day's low when it took out right here. Which is the real low? While the swing line says it's there, I know that prices took that out. So I'm looking to see where the market reestablishes a low. Is it staying in a trend of higher highs and higher lows? The pullback, you had a day over the upper Bollinger Band, outside day down yesterday, and pulled right back to the support. If people are buying it, what they don't want to see is this low taken out right here. Momentum-wise, the market at this point is just snuck itself out of being overbought. In Bitcoin, I have been telling you I'm still very much in the bear camp with lower highs, lower lows. The market today, right at this moment, 78.95 on the close. March is still the lead contract. It'll all move to June soon. I should move that down to 80. It shouldn't be at 90. When we look at the May Brent, it was going up. In fact, I had this morning. I wanted to see where the market would be from this morning, and I did this 9 o'clock. So I did my morning video, and then I went through all my charts early, and I put this line. That's where that was. You can see how much it gave back, because I still think at the $5 range plus, anything in that area, you're going to buy the WTI crude. The spread's pretty big. And yes, I realize today that the Saudis are saying that they and the Russians are looking at 10 to 20-year deals of collaboration and price cuts. I gave my opinion then. Russia does what Russia wants when it suits Russia. It's that simple. Higher lows, higher highs, embedded reading. So while the market is pulling back, all the charts are up. We had the API numbers today. They look to me, when I first saw them, I thought the market might have bounced a little off of it. They didn't. I think they're going to look tomorrow at the EIA number. Remember, you're looking at prices that have already seen the API numbers. When we go to WTI, overbought, not embedded. So the Brent is a stronger market, and we're seeing that in the spreads also, than the WTI. In the gasoline market, will we embed? Again, what's embedding? Both numbers staying over 80 for several days in a row. So we got that today. This is Tuesday. We had it Monday. Did we have it Friday? No. So you're up now again to see if this market can do that tomorrow. And on the nat gas, you came out of an oversold condition that did not embed, hit its lower objective coming up. I think the market's just going to be doing this for a little bit now. The weather pattern has come out for early April, and they're saying it's going to be colder in the Midwest and Northeast, which gave the market a little bit of a bounce. We don't know when the warmer weather is coming in. As you can see, all the boards are cleared behind me because the market is now getting ready to do what? Open for the evening trade. With that in mind, I want to remind you about the research we provide, and it's in currencies, education, the energy markets, the financials, the grain markets. You're going to have a big grain report on Thursday. Then you get the meats and the metal market. So we cover everything, the softs. You don't get firms that do all this. We do it as commodity people, and I think you'll find the quality of the research something you want to take a hard look at. If you haven't tried it before, we'd like to give you a limited trial to it, no charge, but you get to see what our traders see, and you can pick and choose the subjects you want. How do you do it? Give us a call. Go to our website. You can click up here at any point or underneath us whenever you need. Just click there, and it'll take you right to that page where you can sign up for this. I'm Ira Epstein. Have a good day.